Hello and welcome to a new episode of Interpreting India. From geopolitical complexities to economic uncertainties, India faces critical challenges in its quest for a more prominent role on the world stage. This season, we at Carnegie India continue to bring voices from India and around the world to examine the role of technology, the economy, and international security in shaping India's future. Today's episode is the first in a special three-part series based on Views from Taipei, essays by young Indian scholars on China, a compendium published recently by Carnegie India. The series brings together fresh perspectives from emerging Indian voices who have studied China from up close. China is the world's second largest economy, and by some measures, it's the world's largest economy when measured by purchasing power parity. Its deep integration with global supply chains means that the state of its economy and the pressures it faces will have ripple effects and implications for economies around the world. Particularly at a time when global geopolitics and geoeconomics is becoming more contested, fractured, and securitized, these linkages are fraught with even more tension. Economic pressures will also affect the confidence with which China executes its foreign policy and its relations with the world. Separately, and obviously, the state of China's economy has domestic implications. For the Chinese Communist Party, whose political legitimacy over the past 4 decades has been built on China's economic success and its robust, sustained GDP growth, economic headwinds risk political discontent. I'm Saheb Chadha, Senior Research Analyst in the Security Studies Program at Carnegie India. Joining us for this episode and to discuss all of the issues I just outlined above is a distinguished guest, Amit Kumar. Amit is one of the contributors to Views from Taipei, and his essay, The Pulls and Pushes Within the Chinese Economy, explores the structural and policy dilemmas that continue to challenge China's economic trajectory. Amit is a staff research analyst at the China desk of the Indo-Pacific Studies program at the Takshashila Institution. With a broader focus on China, he studies issues at the intersection of the economy, technology, and security. His work encompasses writings on the Chinese economy, domestic politics, foreign policy, and India-China trade and security issues. I'll also be speaking with the other two authors from the compendium in the coming weeks. So stay tuned as we unpack different dimensions of China's military, economy, and border strategy through the lens of young Indian scholars. Amit, welcome to Interpreting India.
Thank you so much, Saheb. Pleasure to be here.
It's a real pleasure to have you. So we'll dive right in. I'll ask you a broad question, which is on the state of the Chinese economy at the moment. Now, in your piece, you lay out the three dilemmas that China's economy faces: the fiscal stimulus dilemma, the property sector dilemma, and the rebalancing dilemma. Can you shed light on each of these and also tell our listeners to the extent to which Beijing is actually addressing these dilemmas, in your view, satisfactorily or otherwise?
Yeah, thank you so much, Saheb, for that question. So, to answer your question, and before I delve into the structural imbalances within the Chinese economy, it is important to take stock of how the Chinese economy has performed in the last couple of years or so, right? So it's quite clear by now that China is facing a structural decline, right? The growth rate this year that was reported early in March was about 5%. The target was 5%. If you look at the growth rate in 2023, it was somewhere around 5.2%, if I'm not wrong. And a year before that was about 3%. So you see that there has been a structural decline in the growth rates, right? And this decline is not something which we are witnessing now. This started somewhere around 2015, if you would look at the metrics, right? And even here, right, if you look at the data, you would find that there are some credibility issues there. People point to the problem that there are some accounting issues with the Chinese and how they calculate the economy or calculate the GDP. So you look at these figures from past years. Now you have seen that the past few years people have also, several economists have also pointed to issues with accounting of the Chinese economy, and they've pointed out that the accounting practices that the Chinese do, and it's quite evident in some cases, does not take into account a lot of factors, as a result of which you see that the Chinese economy is growing at 5%. So if you take and those analysts believe that the economy is actually growing at somewhere around 3%. So point of the fact of the matter is that whether you take those accounting practices into account or not, the fact of the matter is that the Chinese economy is structurally it's moving towards a structural slowdown. Now, you have other worries as well. Deflation is one of the biggest worries. It seems like the Chinese economy has gone into a deflationary cycle, and I say so because for the last 2 years, the CPI has been consumer index that we refer to has turned negative or is hovering somewhere around zero. And what this does is when you calculate the GDP, the numbers that we are used to seeing or reading in the newspapers and the one that the IMF or respective countries come out with, they use real GDP data. The real GDP data is uh, calculated by discounting inflation, right? And if and what it does is that it brings down the nominal GDP rate. So you have to take that out of the picture, and you therefore look at the real GDP account, right? GDP numbers. And the real GDP numbers is always less than the nominal GDP growth rate. But when you enter into a deflationary cycle, what happens is that the real GDP numbers get inflated, and the two nominal GDP and real GDP, they flip for positions. And this is what has been happening with the Chinese economy for the past, I think, 2 years. So even though the economy has not grown by a much larger margin, deflation has meant that the real GDP, the target of the real GDP has been achieved. So this is one of the problems. Domestic consumption is one thing that I think you also referred to in the beginning, the three imbalances that I talked about. Domestic consumption, and I think we can go ahead and we can explore the questions in detail further. But I would like to take that factor and point to the fact that China is an outlier when it comes to domestic consumption. If you look at other countries, I mean, you have four components of GDP, and domestic consumption contributes to about 60% of the economy in other countries. In China, the case is China is quite an outlier in the sense that you only see that 40% of the economy is driven by domestic consumption, right? So China is an outlier in the sense that while other economies, you see that about more at least 60 to 70% of the economy is driven by domestic consumption. In case of China, what you see is that the number drops to about 40%. And this has been something which has remained consistent for, I would say, more than 20 years now. And China was not always like this. China, when it started out after the revolution in 1949, for better part of the history, its domestic consumption was somewhere around 60%. It started to change after the economic reforms which were undertaken in 1978. And later, when China made an entry into the WTO order, the trading regime, you saw that these numbers changed drastically, and China's domestic consumption, its share in the domestic to the GDP, dropped to 40%, and that's massive. No other country in the world today, at least as for a country like China, which is the second largest economy, the consumption is this low. Even for other export countries, if you have to name a few, South Korea and Germany, even they maintain domestic consumption of over 50%. That is what their contribution to their economy is. But what this does is, and this is the imbalance where I'm coming about, which I'm pointing to, is when you have this low a consumption, it's a structural imbalance within the economy, because a major part, given the four drivers of the economy, which you have the consumption, uh, net exports, investments, and then you have government expenditure, right? Uh, Consumption has to power the economy. But in case of China, what you have seen over the years, especially from 2001, after its entry into the WTO, that investments have powered the economy. And this is structural economy, and this has implications for the world. And because you have the economy is driven by investments, and your domestic population does not consume much, what essentially happens is that much of your production, what you produce within the economy, has to be exported out, has to be consumed by someone else, right? And this structural imbalance now, after 25 years, you are seeing the consequences playing out, where you have seen now that China's trade surplus has hit has reached almost about $1 trillion, right? Last year, almost about, it was somewhere around $980 billion, but yeah, you can round it up to $1 trillion. So this is structural imbalance within the economy. This is the first that I mentioned in my essay. The second thing, imbalance that uh, we come about with respect to, I mean, there are many imbalances, right? But the one that I talked about in the essay was the dilemma over fiscal stimulus. Given the fact that domestic consumption within the Chinese economy is less, one way that the economists have argued over the years to correct this imbalance is fiscal stimulus. That is essentially that you pump in money in the economy, and you do that by pumping or providing cash in the hands of the people, which would then consume, and this imbalance would then correct. But then, given the nature of the Chinese state, welfarism is, these are called these fiscal stimulus or cash transfers, is something which is not looked at very favorably. The Chinese uh, in the dynamics of China's party state, and they think that these are wasteful measures and signs of welfarism, which should be avoided, right? And the other reason why the government has, or the party state has not engaged in these kind of things, because an investment led economy, which is export oriented, has given them a geopolitical or geoeconomic leverage in the long run, right? Uh, if you today look at China's share of global manufacturing output, both by value and volume, it is somewhere around 30%. And this position, the preponderant position that China has gained in this world order, is owed to its investment led model, right? And it doesn't want to give up on that model. If you correct the imbalances, it might mean that you might bring some benefits for the domestic economy. But in the geopolitical terms, it might mean scaling back on the investments, and therefore the exports, the trade surpluses, etc., which gives China a leverage largely in the geopolitical order, right? The third imbalance that we talked about, that you referred to, was with respect to real estate. So real estate is, again, when I talk about China's investment led model, real estate has been a central feature of that investment led model. A lot of money was pumped into the sector, and after 1991, and then later after 2008, and a lot of investments were driven by the real estate sector. It accounted for about a quarter to a third of the Chinese GDP, depending upon how you calculate its contribution. But this it had become the consistent investment had become unsustainable for the economy, and the China's party state was aware of this problem. Back in 2011, there were calls made to correct it because of the inflation of the property bubble, but no leader except for Xi, I think, had the political will and the capital to act on it. And while Xi Jinping did crack down on the property sector, what it did was the investment cycle broke. You saw a property slump in the market. The prices of houses for first time buyers and second time buyers dropped down heavily, and which they could never recover. And as this happened, the spillover effects was seen in the larger or the wider economy as well. You see, after 2018 or 2019, after the crackdown was effected, you see investments have also declined in the economy, although it does retain the percentage contribution into the economy, but in aggregate terms, if you look at it, the share has declined. So these are three imbalances. Now, the problem is that real estate contributed to the economic rise, but if you deflate it, because it would turn out, if you do not, it would become a macroeconomic problem in the longer run. But if you deflate it, it has had consequences for the economy, which you see in the dropping GDP rates. So these are the broad three imbalances, or the structural imbalances that I had referred to in the essay.
So, thanks for that. We'll sort of take off from your piece. You made clear that the nature of the Chinese economy makes it heavily dependent on its linkages with the world, and so therefore China has to care a lot more about its approach to the world. So, which is a good segue to my next question: is how exactly are these economic headwinds shaping its approach to international relations? I mean, the headwinds are also from abroad as well because of US-China economic competition. And scholars have speculated that these headwinds, internal and external, are driving China's outreach to various actors: Japan, its neighborhood, India. And I'll come to India in a separate question. But what's your view on this relationship?
There's no Chinese approach to the in economic terms to the outside world. The structural imbalance within the economy itself enforces an approach. I mean, you can. It's a catch-22 situation, but the structural situation is such that it enforces a approach on the world. Get back and see a few features about Chinese economy, right? So Chinese economy is also led by extremely high savings. Extremely high savings. It is somewhere and at its peak in about in around 2009 or so, it reached to about 52% of the of the GDP. That is something that is unseen. Again, China is an outlier and something that is unseen in the wider world. Now, I did mention that China is an investment-led economy, but if you largely see, most of the countries in the trading order would have investment surplus over savings surplus, right? They would save less but invest more. In China's case, the investment is high, which is higher than the aggregate investments that you observe in other countries, but savings is extremely high. And what this does is this has a macroeconomic consequence, ramification for the outside world. So every country which maintains a positive surplus of savings over investments in the domestic economy has to run a current account surplus. That's the only way that you can balance it, because in macroeconomic calculations, savings minus investments equals to exports minus imports. That's something you get. So the structural, so the imbalances that we talked about in the initial part of the podcast, right, of this episode, was because China is an investment-led economy, and because it invests a lot, it consumes less. So all these factors come together: higher savings, higher investments, less domestic consumption. These factors come together to have a positive or trade surplus situation that China sees today. And this is largely the approach or something which the world is worried about. If you look at for the past 2 years or so, the concern in the world is that we are growing increasingly dependent on China, and China is flooding our market. So that's called financial depression, right? Then China also engages in currency devaluation. You would see downward revision of renminbi to keep its exports competitive, imports very costly, low interest rates, and massive subsidy. Massive subsidy is a big problem in Chinese economy, and this together, when when these together come, it creates a problem for the outside world that it is seeing today. The US has, before Trump came in and imposed retaliatory tariff on April 2, you had seen that a consensus was building towards engaging or confronting China's overcapacity problem. All these problems have led to overcapacity in the China's domestic economy, right? What it essentially means is China is producing a lot more that can consume, and that amount is way too large for the global economy to absorb without, and it has political costs for those countries, right? And therefore, you see that a consensus was developing among the countries. EU had slapped uh, countervailing duties and import duties on Chinese EV, but what you had now, this seems to be a little in the resolved might have now given way because how Trump has now reacted. So the problem that Trump is also trying to address, a part of the problem that he's also trying to address is China's overcapacity and huge trade surpluses, as you would notice in his remarks, in his speeches, etc. Again, over a period of time, if you look at his speeches, the goalposts have been shifting. But now what it has largely come to is addressing China's large trade surpluses. So China's large trade surpluses is a problem for the world. And if you look at the total trade surplus that it had garnered last year, $1 trillion, of that 71% came from US, EU, and India alone. About $300 billion from US, another 300 from EU, and about $100 billion from India. 71%. These three entities account for 71%, and there's no doubt why, no reason to see why these countries would not be concerned. This also means that, and US's problems are domestic. The thing with this is that it also has the fact that China has risen into global manufacturing hub, has geopolitical implications for the US, right? And therefore, you see a sort of attack that has been mounted on Chinese economy even before the Liberation Day tariffs came in. US and EU were getting in some sort of understanding to tackle this. There was a consensus that was building, at least among even in the business community and the government and within the governments, that China's overcapacity has to be tackled. It has implications for domestic economy, and after Liberation 2, I think it might have taken a backseat, but issues remain. And therefore, you see these kind of frictions between US and China. And then what China is trying to do is largely countering what the US has done, going around and making promises, trying to assure that things will not be impacted in other countries. But if this has to be addressed, the situation has to be addressed. It has to be addressed between China and US, EU, and India.
Okay, I guess what I was trying to get at was that how much have these sort of economic headwinds prompted China to attempt to mend its relationship with various partners that it's sort of, let's say, antagonized over the past few years. For example, India. I mean, I guess what I'm drawing from what you're saying is that China needs markets because it's an export-led growth model. And given that economic barriers across the world are rising and there's this pushback to China has to try to stabilize some of that, but also reach out to newer partners. Would that be a fair way to put it?
China's first response, one of the responses that China came up with in response to Trump's Liberation Day tariffs, was to go around and build small coalition, show support in favor of free and fair trade, etc. Xi Jinping had toured 3 countries in Southeast Asia: Vietnam, Indonesia, and Malaysia, if I'm not wrong. And you have also seen how China is trying to not mend ways, but build relations with Africa, Latin America. Now, some economists do point out that the next phase of demand would come from largely these economies. But I have a problem with that. I do not believe that these markets in either South Asia or Latin America or Africa could replace the demand that you see in US or EU. Now, China can go around and build a global coalition against the US and pressure it into giving, restraining some of the measures. But the fact of the matter is that China's largest export destinations, or where the demand is created, is the Western hemisphere or the Western countries. Now, why I say this is because for demand, you need two things. You need people, that is consumers, and you need pocket, the size, yeah, right. And in terms of mm, GDP per capita or uh, per capita income, you have the highest demand in the US and Europe. Those demands cannot be replaced. The kind of demand that would come from Latin America, say Latin America or Africa or South Asia, or even to that matter, somewhere in Central Europe, Central Asia, etc., would be very different from what your current demand is, or which the Chinese exports are catering to. So it's a political as a political symbolic thing. It makes sense for Xi Jinping to go around and make coalitions, but in China, you might see some concessions from China on these when it goes to these countries. But the fact is that China emerges as the largest trading partner, and in more cases, more often than not, it is also the largest exporter among the two countries. So the trade imbalance is very heavily skewed in favor of China. So even if some concessions are given, China would still emerge at the top with high trade surpluses with other smaller countries. And if it has to actually find a solution, therefore I say it has to get back and find a working solution with at least the US and the EU, because that's where most of the China's exports are catering. The demand comes from, and the Chinese exports are catering to.
I think that's an sort of interesting counterpoint, that it's the Western developed economies that have the demand, and you can't sort of replicate that demand with some of China's newer partners, which I think is an interesting, and it's an apt segue to my question about India. Let's come to India, China. Both sides have been engaged in a standoff in eastern Ladakh still. I mean, you've had disengagement, not de-escalation yet. It's been suggested that what we've been talking about, China's economic challenges, need to reach out to newer markets, coupled with sort of the impending return of Donald Trump to the White House, that might have played a part in China's outreach to India last year. What's your sense on that particular point?
On the kind of agreement on border that we had?
I mean, how much was this economic incentive or driver of China's outreach?
Yeah, I don't think there was any economic incentive to what happened last October. There was no such, and my understanding is also very similar to yours. It was perhaps because of the feeling that the Chinese had, that Trump might come to power, and that would bring more uncertainty in how China deals with America, right? And that would create more problems for the Chinese. And it wouldn't make sense for them to have two fronts open, in the sense, I mean, largely on one on the economic front, and then here in again vis-a-vis India. So it made sense for them to withdraw, take a step back, and work around economic incentives. I don't think so. See, when China comes and asks a country to be a trading partner, and every major or small country that it goes to, China has nothing that it wants to buy. China has replaced almost, if you see in terms of machineries and electronics, it has replaced the West to quite an extent. It does not come with demand. It comes with the Chinese delegation comes with supply list, things that they can supply to the other market, and that has been the case with India as well. I mean, I'll give you an interesting stat from 2010 to 2025. China's exports to India, that is what India imports from China, has risen multiple folds, from about 30-40 billion dollars to about 135 billion dollars. Right? India's exports to China has remained stagnant at about 17 billion dollars. Even 10-15 years ago, it was somewhere around 14, 15, or 16 billion dollars. Depending upon which year you take the data from. but it has yet not crossed. It has largely remained in the range of 15 to 20 billion dollars. So China does not has the demand that other countries would like to cater for. I mean, China has its markets closed. I mean, imagine China is dealing with an overcapacity problem. It is already producing more than what its people can consume. So it does not come with, it does not it doesn't have a demand that maybe your country can cater to. So there was no economic incentives. This is with respect to trade. With respect to investments, again, very quite interesting. If you look at India's FDI data, hard data, you'll find that even if you include Hong Kong, I mean, it operates as a separate economic entity from China. Even if you add, take into account Hong Kong as part of China in that sense, you'd see that China has never figured in the top 20 investors in India from 2001. Never. Even if you account for both Hong Kong figures and China mainland figures. And its cumulative investments in India in the past 20-25 years is below $80 billion. That's for an economy as large as China. That's very less, very, very less. Some 70-80 billion dollars is what India got in a year. FDI worth of FDI that India got in a year, somewhere around 2016 or so. But for a country like China to have a cumulative investment of about $80 billion in 25 years in India, that investors around the world consider as the emerging market, maybe next China. So that tells you that China is not interested in investing in India. Now, you had instances of Chinese companies like Xiaomi and other smartphone companies investing in India. That is one sector where you could actually see a lot of investments. But apart from that, Chinese investments were mostly restricted to equity and shares, and that is what that had during, if you remember, during COVID, China's PBOC had acquired stakes in HDFC, and uh, people call it like China's ambitions and intentions were predatory, right? It was an opportunistic takeover, and that had kicked the Press Note 3.
Press note 3.
Yeah. So if you look at in terms of economic incentives, I mean, even if you look at the narrative that is coming out of China in the past 6 months, China doesn't want its high-tech companies to be invest in India, because there's a larger geopolitical game as well, where it sees India as a rival, especially now that you think of global supply chain resilience, China plus one strategy. I don't know it's certainly been not very successful, but it makes sense for China from geopolitical sense to thwart any attempts towards China plus strategy. Now, with Trump coming and countries across the world realizing that there is a China problem, there's a China capacity problem, there is China dependence problem, and therefore you need to reroute supply chains and cultivate other centers of maybe manufacturing power, something. And India does emerge as one of the alternatives. So in that sense, it does not make sense for Chinese to come and invest in India. So something that they have gathered over the years and acquired from the Western countries, it does not make sense for them to diffuse those technologies in India. And so that would be my answer to your question. If there are any economic incentives, I don't think.
So what I'm understanding is that it sees sort of limited economic opportunity, but then why does, when Xi Jinping meets Modi, he says development is the single largest common factor between India and China? Why is the Chinese ambassador writing an op-ed in the Times of India and other newspapers saying that, we'll open up markets, we're not going to, impose tariffs, and we're not going to sort of be part of this economic sort of geo-economic mood swing, let's say? So then what is the incentive that it sees? It's not, as you said, investment. It's not demand. Is it new markets, or what is it?
So no, I said investment is not an incentive. demand in India is an incentive. So they want to keep exporting to India because India is an emerging market. India's consumption is huge. Despite the tension that you have seen in the last 4 or 5 years from 2020, the sentiments against the Chinese imports had become very negative. And yet you had seen that in 2023, the trade deficit crossed the $100 billion mark. Despite the tensions that were there in India, between India and China. So the thing is that India has the demand. And India does not have an as illustrative uh, and deep manufacturing base as China. And India does not produce a lot of things that it needs. And a lot of these are either intermediate goods or capital goods. And China manufactures them on a scale and at a cost that suits India. So there's always demand for Chinese goods in India. And it's not all bad. We do benefit from that, especially when they're capital goods or intermediate goods. The manufacturers or the exporters, export-oriented section of India's economy benefits. When it is a consumer good, people like you and me benefit. But there's also that incentive is there. China does want to export a lot of its does not want its exports to be does not want the Indian government to create a barrier for its exports into India, and that incentive is there. But insofar as the talk about coming here in India and setting up factories and then exporting that back to China or other markets is concerned, the Chinese are not very interested. And let me just add to the point that you said. What explains the Chinese leaders going around and saying that development is one single common factor or denominator in India? There's difference between what China preaches and what China practices. So there's a lot of difference in that. China does go around and say a lot of and throws around a lot of lofty words, but when it comes to practice, it has never practiced any of those things. So when it entered the WTO regime, there were certain promises that were made by the existing WTO members and promises that were made by the Chinese. Chinese have never held their end of the bargain, while the other members have. And therefore, you see a great resentment among the Western countries, especially the West, especially the US, where they single-handedly blame China's entry into the WTO as the reason why China is where it is today, and what it was a blunder that the US and the other Western countries made to accommodate China. But what it has largely led to is China has not returned the favor. China has not made amends in its ways. China has rather flouted every single principle and, in fact, benefited to an extent that now it is the second largest economy and by a huge margin.
I think my takeaway from this is that this reinforces your point that China's outreach to last year was geopolitical rather than economic, because if it was trade and market access, that had been rising for the past 5 years anyway. So that wasn't new. It didn't change last year. Okay, this leads me to sort of my final question. You referenced this that, this Indian industry hopes that China will set up sort of manufacturing here. So then if you sort of looked at what industry is saying, they're suggesting that you need engagement with China to advance India's manufacturing sector and move up the value chain. How much merit is there then in that proposition? And this is my last question.
So with respect to, there are multiple actors when it comes to China plus one strategy itself, and the ambition, India's ambition to move up the value chain. So from China plus one, or largely, it's China plus one is a result of two things. During the COVID, the world came to recognize the Chinese manufacturing prowess and the overcapacity both at the same time, and therefore it was considered that you have to have, and added to the fact that China's aggressive foreign policy or belligerent foreign policy had become very frequent. Was very frequent in its actions with other countries. So this idea of China plus one came about, and you see the idea of China plus one, there are not just Chinese companies that are a player. Of course, Chinese players play a large and very important role in making China the global manufacturing hub. But there are also foreign enterprises that are practicing in China. The biggest examples are Apple, Tesla. There are other semiconductor companies, etc. Samsung, right, which has their operation. Intel, which have their operations in China. So Chinese companies might not make a move, but it would make sense for those companies, those foreign enterprises to make a move. Now, this is where things get complicated. You just do not have India as a viable option. You have countries like Vietnam, countries like Malaysia, Thailand, and even Mexico, which are vying for that spot. But where India is differentiated, or India is different from its competitors, is India has a huge burgeoning consumer market. India is the only country in the world that can rival China's scale of consumer market. No other country. So again, as I mentioned at the beginning, there are two components to a consumer market. One is population, the numbers, and the other is money. In terms of numbers, India is the only country which can match up to the size of China's consumer market. In terms of per capita income, we still lag behind, and therefore are about a fifth when it comes to consumer market. But if you see a sustained growth over 2 or 3 decades, China and India are the only countries that can sustain massive and enormous consumer markets. So that is something which the other countries do not have. And this is where the crackdowns, the crackdown that the Chinese government or the party state has done on the foreign enterprises that were operating in China, and the pressure from the US administration or even EU on their respective businesses to align their business interests with the strategic interests of the state, is coming together to make those foreign enterprises consider a shift, right? At least when it comes to their new investments. And Apple, in that sense, I think a Foxconn setting up a factory here is, in that sense, is an indicator. And what it would actually do is that it would, when initially Apple shifted to India, there were a lot of shifted its production based to India. There were a lot of talks about whether India would be able to match up to the standards and the return time, or the period that is. China was producing iPhones at a faster rate than India, and whether India would match that pace. So, and over the years, India has, right. So it's an indicator that if you give enough time, India can catch up to pace, and at a pace that China is producing things. So this is where Chinese enterprises might still not come, but it does make a case for other companies operating in foreign companies operating in China to shift their bases.
That's thought provoking, at the very least. I'll say that, and does sort of demonstrate the opportunity that India has, even if not from Chinese companies. Amit, it's been a real pleasure having you on the podcast. I think we managed to delve into quite some depth in the Chinese economy and the nature of China's economic engagement with the world and with India. And I don't think there is enough conversation around this. So I think I learned a lot from this conversation. So thank you
so much
for sharing your time and your thoughts with us.
No, it's always a pleasure, Saheb, talking to you. And thank you so much for inviting me. Thank you so much.
Yeah. We'll be back in 2 weeks with a new episode. To make sure you don't miss it, be sure to subscribe on Apple Podcasts, Spotify, YouTube Music, Stitcher, or wherever you get your podcasts from. To learn more about our research and team, you can visit us on our website at carnegieindia.org You can also find us on social media on X, Facebook, and Instagram. Thank you for listening. See you next time.